So then, gentlemen, we're looking at flexible budgets, and I'm trying to explain that you'll be given like a budget here, and then you'll be given actual. So you can see here number of units, 1,000 is what we were budgeting, right? And then we have actual 800, right? Material cost, of course, these are not related. These are not related. So we have material cost, we have labor cost, we have fixed cost like that. And then now out of this information, they want us to give them fixed or other flexible budget. They want us to give them a flexible budget. So how will we be able to do that? How will we be able to do this? It's very easy. Remember, we don't flex this actual. We always flex the budget which is given there. The only thing of the actual we shall use is the actual quantity. Yes, the only thing we shall use is the actual, the only thing we shall use here from the actual is the actual quantity that was produced. Otherwise, ladies and gentlemen, we shall only use what here somebody, we shall only use the budgeted information to get flexible. So somebody called in Jerry tells me to calculate the flexible or flexing ratio. Can somebody calculate the flexing ratio for us from the information? Somebody has already given us the formula. Amesema, chukua actual output all over budgeted output. Very important. All over budgeted output. So chukua actual output all over budgeted output. So like in this particular case, what is the actual output? It is 800 all over the budgeted output, which is 1,000. So this will end up giving me 0.8. And then now, ladies and gentlemen, what I'll do is to go to my budget. I ask myself, which items are variable, are flexible? We multiply them with 0.8. Like materials, I expect materials, the more I produce, I expect material cost to increase. So it's a flexible thing. So it's flexible. I'll apply 0.8 there. How about labor cost? What do you know about labor cost as our output increases? Labor cost will increase as well. So in this case here, we have times what here? 0.8. How about this? So here, I'll come and pick this. This, of course, will be 160. This will be 200 and what here, somebody? 240. How about fixed overhead? How about fixed overhead? How about fixed overhead? Fixed overhead. How about fixed overhead? Fixed overhead. Fixed overhead, we can't flex. Fixed overhead will pick the one under the budget here as 1,000. 1,000. No change. So after that, ladies and gentlemen, no flexing, yes. After that, of course, I expect you to come and give me a column of variances, which means that I have to adjust my camera a little bit. So my column of variances, my column of variances, my column of variances. So please go ahead there and subtract for us. So the column of variances, so in this particular case for variances, ladies and gentlemen, what we have there is quite interesting. Like now we are taking 300 minus now the flexible. So 300 minus this gives me what here, somebody? Please give me these figures. 140, right? 140, thank you very much. 140. How about the next one? 400 minus 240. 400 minus 240 gives us? 400 minus 240 gives us what figure? 160. And then lastly, we have what here, somebody? We have 200. So the only thing you haven't told me is whether those variances are adverse or favorable. We start with 140. 140, is it supposed to be adverse or favorable? So now here, you can't make those normal arguments of variances that this is positive. No. Here you have to reason out that I had budgeted to incur a material cost of 160, but the actual became more. The actual was 300. So you ask yourself whether that favors your organization or it doesn't favor it. So here you must apply some reasoning, not like the ones you use a formula. Here you must apply some reasoning. So hii tunasema ni adverse, ni kweli? Adverse because we can see an overshoot. Overshoot cost-wise, when our actual cost is more than the flexible cost, of course that is adverse. The same case with this. The actual cost is more. It's bad for the business. Adverse. But when you come to the fixed cost, of course, you can see here now we saved. We had thought that we were to incur 1,000, but we incurred less. We saved favorable. Thank you very much. Like that. Ladies and gentlemen, with whatever I've told you and the video that now each one of us has, I'm so sure this one is a done deal. If they bring something like this, concept ni kwamba hautatoka bure, hautatoka bure, usikatoke bure tafadhali, hautatoka bure, hautatoka bure. So your video ni ya kama 30-40 minutes, unaipitia pitia. Na kama unaona unaielewa, usiwaste time sana, una fast forward. Ama unaachana kwa unaelewa, usiwaste time kwa kitu ambacho unaelewa sasa. Usiwaste time at all. Now, ladies and gentlemen, there is something that you guys are not looking at all. Hii kitu ya performance appraisal. Na performance appraisal, unafaa kujua vitu chache sana. Performance appraisal, unafaa kujua nini under performance appraisal. Under performance appraisal, unafaa ujue concept ya ROCE, right? How do we get ROCE, return on capital employed? How do we get, in this case here, the net profit margin or gross profit margin, right? How do we get, for instance, the assets turnover? And ladies and gentlemen, please don't forget the concept of what is residual income. Residual income. So is there anybody who remembers the formula of ROCE? ROCE tunafanya nini divided by nini? ROCE tunafanya nini divided by nini? ROCE tunafanya nini divided by nini? ROCE ya Olivia already ashapata hiyo. Amesema mwalimu mimi najua sana. ROCE huwa tunachukua profit divided by capital employed. Profit, this is profit divided by capital employed. Capital employed times 100. So profit divided by capital employed times 100. Capital employed is the same as what your net assets. Is the same as net assets. Is the same as net assets. Is the same as net assets. Hiyo ni ROCE. How about profit margin? How about profit margin? Utapata profit margin. Anything margin has got sales down. Sales in the denominator. So profit margin is profit all over who? All over sales times 100. Profit all over sales times 100. How about asset turnover? How about asset turnover? Asset turnover. Asset turnover. So asset turnover, you have to be careful. We normally talk of asset over turnover. But now as the name tells us, it has been turned over. So then it will be turnover. All over, you don't just talk of assets, but what here somebody? Net assets. Turnover. And you see turnover is the same as sales. Timothy, you have to be careful. What unasema ni asset over, but now the entire thing has been turned over. I hope you're getting that joke. So it is turnover divided by what here? Net assets. Turnover divided by net assets. And remember, turnover is the same as what here is the same as sales. So sales over net assets. Sales over net assets. How about, ladies and gentlemen, residual income? How about residual income? Very good. Residual income, what tunasema ni profit minus what here somebody? Minus coca. Profit minus coca. Profit minus coca. Profit minus coca. Profit minus coca.